Welcome to another episode of the Accidental Landlord podcast. I'm your host, Peter McKenzie, and today we have Catrina Craft, who is a certified public accountant, and she is here to talk to us about the most exciting topic in the world, taxes. Catrina, welcome to the show.
Thank you, Peter. Taxes are exciting.
They actually
we
are.
Put that in the universe.
Especially when you save on taxes and you pay less. That's definitely exciting, and not so much the opposite, though. But why don't you take a minute or two to introduce yourself to our listeners and give us a quick bio, and then let's get into this conversation.
Absolutely. Again, I'm Catrina M. Craft. I am a CPA and I'm a real estate investor, so I have skin in the game for over 20 years. I have been working mostly on single-family residencies that I've owned. I've self-managed, and I've had 12. We just sold 3. So a little bit of money taken off the table with these appreciated properties. Also, I work with individuals who are real estate investors, from flippers to wholesalers to long-term rentals, Airbnb, 100-unit apartments, syndicators. So I have experience in a lot of different areas of real estate.
Yeah, I think that's one of the reasons we wanted to have you on, and we want to talk because, real estate investing and taxes kind of go hand in hand. A lot of our listeners are on the newer end of investing in real estate, or as the title implies, they accidentally got into this. And I'm actually shocked the amount of conversations I have with new investors or accidental investors, and when we start talking about taxes, and they're looking at me like, "What do you mean there's benefits to this?" And I'm like, it's shocking to me sometimes. So sometimes it's like helps to go back to the basics, like what are the, let's start there, and then we obviously want to progress and talk about. I believe you and I discussed having like a side-by-side comparison of a long-term rental tax benefits versus a short-term rental tax benefits. Because to be totally upfront and transparent, we've had CPAs on the podcast in the past. We've talked about some of the strategies, but I don't think we ever really got into this is what it could mean to your actual pocketbook and give like real concrete examples. But why don't we start from a high level for like someone who inherits a rental property and they don't know any of the benefits of the tax, the tax laws. Within like a minute or two, like what are the big ones that they should be aware of that are now available to them now that they own a rental property?
Okay, within a minute. Now, there is a lot of deductions.
Maybe a little more than a minute, but not an hour. How about that?
Okay. So the main area I want to address, and we're going to expand on this, is taking depreciation. And what happens in depreciation if you have a single family property or any residential property? You're going to get to depreciate 27.5 years, so 27 and a half years. That means that structure that you have, you're going to get to deduct as a tax deduction expenses related to depreciation of that property. That's basically saying the IRS is saying, we know that this property, as you hold it longer, that you have some items that are going to not be worth as much. It's going to allow you to depreciate it. So that's a phantom expense. Now, what is important is that when you sell that property, you have to recapture that. But there are ways, and we'll get into that you decrease what you have to recapture. So that's really important. Other types of expenses would be if you are doing Airbnb, your furniture and fixtures that are in there, your dishes, your sheets, anything that you need to supply that rental, that short-term rental to be utilized, you'll be able to deduct all of those. Also, I love to say travel, because if you are looking for properties in other places, there may be an opportunity for you to deduct travel. And what you need to do, though, is make sure you're working 4 hours. So the IRS says you have to work 4 hours, but you could look at properties, you can meet with investors, you can meet with realtors, you can meet with lenders. And I suggest you do that beforehand. You set up appointments. Don't just get there and say, oh, I'm driving around. So you really need to have a plan, have it in your calendar, and you are tracking all of those expenses from if you're taking air, if you're driving, your hotels. So real estate could be a very good investment and allow you to take deductions for other things as well.
What about mortgage interest on a rental property? Is that deductible?
Oh, yes. So mortgage
Okay.
interest, your real estate taxes, your insurance, anything that, it's ordinary and necessary. That's how the IRS determines if something should be deductible. And that is, I know, very vague, but what you need to do is work with a real estate accountant, CPA, that understands what's ordinary and necessary in the real estate arena.
I don't want to gloss over what you just said there, because there's plenty of people that I've seen did their taxes with people who don't understand real estate investing, and they end up missing out or losing. I don't know about losing, but not claiming deductions that they should claim. So it's important that if you're going to get serious about being a real estate investor, that your CPA, your attorney, all the people that are there to support you understand real estate investing, because there's strategies, there's things that you can do as a real estate investor that if your CPA, focuses on a different industry and that's where they're a specialist in, they're not going to be doing you any favors, because not all professionals are created the same, right? I wish they were, but in our case,
absolutely. It's just like a doctor. I mean, you have a specialist that may deal with heart. You have one that may deal with diabetes. So you have a specialist that understands CPAs, attorneys. I've worked with many attorneys that did not understand the type of structure that's best for real estate. So that's a whole nother conversation where you may be in a C Corp and that's not the best, holding for your real estate. So please work with an attorney and CPAs that understand real estate.
Yep. I've heard the horror stories where they start deeding the properties in and out and they're in the wrong entity and they're creating taxable events every time. Is that the main thing we're trying to avoid by holding them the wrong way?
Yes.
Yeah.
And not able to move between entities. If you're LLC, it's going to make it a little bit easier for you to do that. So there are some benefits to setting up right at the beginning, because once you're in there, it's hard to get out.
Yeah. Okay, I want to talk about a very specific area, and that is when you have a high W-2 earning person, which we're in Southern California in a very expensive market. A lot of the people that we work with have high W-2 income, which from a tax perspective is probably some of the worst income you could have, right? Like very few deductions available to W-2 earners. But there is a way for them to minimize their tax liabilities, and that is through short-term rentals and short-term rental loophole, which we're going to talk about. And what I'm excited about doing is illustrating that very clearly to someone on why we're saying that this is a potential thing that you should be looking at. I'm not saying that this is the only way to minimize taxes if you're a high W-2 earner, but this is the way that I see a lot of people doing it successfully. So why don't I turn it over to you? Let's set the stage. We're going to do like a long-term rental, short-term rental with some numbers, and hopefully we can kind of illustrate this simply and cleanly for our listeners.
Okay. So as Peter has kind of alluded to, there is a way that you can maximize your deduction when you have real estate, and it is called a cost segregation study. Basically, a cost segregation study is a way for you to accelerate that depreciation. So when I talked about you have 27 and a half years usually for residential property, well, the cost segregation allows you to put those in different buckets. Instead of 27 and a half years, it takes different components and it allows you to depreciate faster, which is 5 years, 7 years, and 15-year property. The reason you want to do that is because although you may accelerate faster and then you have to recapture, like I mentioned, when you sell, time value of money is very important. So instead of waiting and letting the IRS use your money for the 27 and a half years, you get that money now. And like Peter mentioned, it can reduce your taxes. So that's helping you. Inflation. So with inflation, you may be in high inflation when you sell. So we want to make sure the tax rates could change. So time value of money, taking it now is better than waiting till later. Also, you get to deduct faster. So it's a faster interest rate. So I like looking at using the cost segregation study to really maximize. So that's the general part of it. Also, with my clients, I like to say, Then you have more savings. You can fund savings. You can reinvest, buy another property.
Mhm.
And that's one thing I love to tell real estate investors. Don't stop with one property. If you get a cost segregation study done, you'll have money that you can then invest in another property. Then you do it again. So you keep feeding that money.
Yeah, let's put some detail behind that. What does that
Okay.
mean? So like we buy the property, we put it into service as a short-term rental, we do the cost segregation study. We don't automatically just get all the tax money back right then and there when you do the cost segregation study, right? Like what is the timeline of events and where does that money come from?
Yeah, let's give an example. Let's say that you purchase a property for $1 million. I know in California, that's probably reasonable to say you're going to purchase a real estate property.
It's probably a fixer-upper.
Okay, for $1 million. Then what happens is instead of saying, okay, first you have to segregate the land from the structure. Land is not depreciable. So you do not get to do the land. So let's just say the land is $200,000. That leaves you with $800,000 that you have to depreciate or that you're able to depreciate and do cost segregation studies on. What happens then is of that $800,000, the range that you will get to deduct is $150,000 to $300,000. That's the normal rate. So instead of waiting and only getting 27.5 years of that 800,000, you're able to in year one get 150,000 to 300,000.
Why the range? Why the range?
Well, the range is going to really depend on your components of your real estate property. What's going to happen is the cost segregation study will go in and say, okay, you have flooring. Wood flooring could be more expensive than carpet. So when you look at cost segregation, when you look at 5 years, it's anything that could be removed easily from the property and not cause any type of damage. So we're looking at carpets, we're looking at hardwood flooring, we're looking at the blinds. So all of those types of things, it will depend on how many components you have of those 5-year properties. Then we're going to look at 7-year properties. And what's interesting about 7-year properties, it could be the property that you have, the asset, plus the components that go along with it. So I'm going to give you an example. If you have a TV, that TV you take off, but anything behind that TV, if you had electrical circuits that's tied to that, that also gets to be 7-year property. So you're talking about the components of the TV, the wiring, everything to the circuit board. When it ends at the circuit board could be a part of that component in the 7-year. So that's why it could fluctuate between 150 and 300, even on $1 million property. It's going to depend on the components that you have in that home.
Okay. Let's just use the 300,000 just for the sake of our calculations. Then where do you go from there? And by the way, I did the 27.5 year on the long-term side off the $800,000. That's roughly $29,000 a year. That would be your deduction. So just so we have some comparison. Okay,
great. So 29,000. And now we're going to say we're doing a cost segregation and you're going to get a $300,000 deduction.
So that's go ahead. No, go ahead. Sorry.
So that's money that you will then be able to deduct. That's a deduction that you'll have for depreciation on your tax return. Now, what you need to know is maybe once you look at your tax rate, let's just say you're at a 20% tax rate on that. Okay. So it's not like dollar for dollar. It's not a credit. It's a deduction. So then you're going to say, I'm in the 20% bracket, multiply that 20% times the 300,000. That's your savings.
And that is actual tax that you're paying less of.
That's actual tax you're paying less of. Now, what you need to realize, though, if you do not have that much in tax liability, it rolls over to the next year and the next year. So you're not losing it. So it's best to do a cost segregation study when you do have taxable income. But if you do not, know that it could roll over to future years.
Yeah. So in our example of a high W-2 earner, they more than likely have taxable income every single year with minimal deductions. So this makes a lot of sense. So let's say our W-2 earner has an income of $300,000 a year.
Okay.
And more than likely they're not in the 20% bracket, right? They're more than likely quite a bit higher than
Yeah,
that.
30% or more. Okay.
Yeah. So how would that same cost segregation study, if they end up with a $300,000 depreciation deduction, how does that work for them that year? So they have $300,000 of income, $300,000 of deduction. Obviously, they got payroll taxes and things that they've already probably paid into. How does that change their tax situation for that year?
So let's assume that they have a liability still of $20,000. Is that reasonable to say that they still owe $20,000 even though they've had W-2 taxes taken out?
I would say they probably owe more than that, but yeah.
Okay. So let's just give $20,000.
Okay.
So if they owe $20,000 and then they're going to have the cost segregation study, that cost segregation study, like we said, they're going to get a savings of, we said 20%, but I really probably think it's more like 30%. So let's just say $90,000 in savings. That's going to offset the 20 that they would have to pay. They will no longer have to pay that 20, and the W-2 money that they've already paid in, they'll get a refund on that money that they've paid in.
Yeah. So, I mean, if they're at a 300, obviously this is hard to use hard numbers on because there's a lot of factors, but if they're already getting, what do you think they're getting deducted out of their W-2 income? 20%?
Let's just say, let's say 30%. So
30%. Okay. So they've already got $90,000 deducted. So if they have $20,000 liability still, they're literally getting the 20 minus 90. So $70,000 back when they file their taxes, essentially.
Correct.
So when people say the problem with doing a cost segregation is you have to keep doing it if you want the same benefits. Well, the big benefit is you're going to get a $70,000 check when you file your taxes. And I don't say most, but a lot of investors will then just take that $70,000, plop it on the next one, do it all over again.
Right.
Obviously, if you're buying $1 million houses, $70,000 is probably not going to be sufficient for the down payment to finance it. But there's creative ways and there's ways that people do it. But that's why they say do the cost segregation. Instead of giving the money to the government, give it to yourself and go do it again and again and again and again. The downside to that strategy is if you stop doing it, you go right back to paying taxes, right?
Exactly. And we did not mention that's federal. We did not mention states. So some states allow you to use that bonus depreciation as well, that accelerated depreciation. So you could possibly get some money back on the state level.
So what is the short-term rental loophole? Like why because in theory, to deduct passive losses against active income, you're supposed to be a real estate professional, right? I don't want to get into the weeds on this because it's relatively complex, but if you're a real estate professional, you have the ability to take passive losses against active income. Is that accurate?
Yeah. So for most long-term rentals, the deduction for cost segregation, you can use to offset other rental properties or passive investments.
Right. So that doesn't generally help people with high W-2 income because they're not even able to take it once they exceed a certain income amount.
Right. The 150. Yeah. Unless someone is a real estate professional, and that's a whole nother discussion. Right. But on the short term, then it becomes ordinary.
Correct. So that's what I want to talk about. Why do people pick short-term rentals? What about it makes this better than not?
Yeah. So when you are doing short-term rentals, it's not passive anymore. It's ordinary. And you need to make sure that on some of those, when you're looking at Airbnbs, especially, there's a term of how much service that you're putting into the Airbnb or the short-term rental. And then it becomes ordinary. That ordinary, then you're not limited like you would be with the passive, that 150,000, and you're able to use the cost segregation really well. So I like doing, especially high income earners that cannot be real estate professionals because they just can't spend that much time. And they have other jobs that they're spending more time on. Then the short term rentals work really well and use the cost segregation study.
Yeah, it's essentially a hack. It's like a legal. This is not nothing shady about
Yeah.
this. This is a
Yeah.
legal hack in how to take your high W-2 income and pay a heck of a lot less in taxes. Because the way the government looks at short-term rental is it's not a passive activity. And I
Mm-hmm.
know from personal experience owning short-term
Yeah.
rentals, it's a job.
Yeah,
It
it is a
requires
job. I mean, you're there. You got to make sure it's clean. You know, if you're doing it or someone else is doing it, you're still managing that, and that's
yeah.
a lot. If somebody's moving in and out every 3 days, it's a
It's
lot.
running a business, and it's no different than if you had, a regular service business in the town you live in. The IRS looks at it the same way, which is why they let you take that tax break. So
Right.
that's it in a nutshell. So in our example, you take $1 million property, somebody buys it and rents it out long term. They get a $29,000 deduction against their income if they make less than 150K. Which, if you're buying $1 million rental property, the chances that you make more than 150K are probably pretty high.
Mm-hmm.
So that, from a tax perspective, is not like the best thing in the world for you. But you take the same property, you convert it to a short-term rental, and now you're looking at roughly a $90,000, or I guess in this scenario, a $70,000 rebate, and you pay a heck of a lot less taxes. The downside is you have to deal with a short-term rental, and it is work. My question for you, Catrina, is what if you do this for 1 year, a full year, and then you go, I don't really like doing the short-term rental thing. I want to convert it to a long-term rental. Do you have to give back that money you got from that full year of short-term rental deduction you got out of it, or does it just change?
No, you don't, because you've already taken that cost segregation study for the time that you had it. Even if, and I've had some clients do this. We had a property that they lived in. They moved it to a short-term rental, and then they moved back into it, and then they moved it back to a short-term rental.
Oh, wow.
So yeah, so in those cases, you really have to look at what's going to make more sense, because then if you sell it and there's a loophole that if you stay in the house 2 of the last 5 years, so that's why they move back and forth, you don't have to recognize $500,000 worth of capital gain if you're married. So then you need to look at, okay, which situation is going to be better, to sell it as a rental or sell it as a resident, a permanent resident.
Right, which that happens to a lot of our clients, because most of them are accidental landlords. That 2 out of the last 5 years rule becomes very relevant to them, because
Mm-hmm.
all they have to do is move into it for 2 out of the last 5 years, and then they get, like you said, up to $500,000 free of capital gains taxes. Um, what's the downside to this strategy?
So a couple of the downsides is, if I would not necessarily suggest you doing it if it's under a property that's under $250,000, because the cost is usually at least $2,000. So you may save $2,000 on a property that's under that amount, but it just levels out. Another negative would be if you do the cost seg and then you don't have taxable income. So then you're not really able to use it, and you've paid that money, and then you still have to recapture it when you get ready to sell the property.
Mm-hmm.
Recapture would be another negative, that when you sell, you do have to pay a recapture tax on this. But the good news is, if you have cost segregation studies and say you have a 5 year, a 7 year, and you sell it within 7 years, well, you've depreciated all of that. And so you need to make sure, if you have done the cost segregation study, when you sell, you do not include those amounts in your calculation for the basis, because that's now all written off. And a lot of people miss that. And a lot of people miss that if you get a new roof, you need to go ahead and remove that roof that you had off the books, and you don't pay any recapture when you do a partial disposal. And a lot of people miss that. So they're depreciating 3 roofs on their property when they should have disposed of that, not had any recapture on that, and started the new cost segregation on the new roof.
That's news to me. I didn't know that, actually. Interesting.
Mm-hmm.
What
It's called partial disposal.
Gotcha. So I've heard people say, I don't want to do depreciation because I don't want to get hit with the recapture tax when I sell it. And I've heard conflicting things on this, but does the government give you the option to not depreciate and not recapture?
They do not.
Yeah.
So depreciation, whether you take it or not, the IRS is going to calculate that you should have. And that's one thing that if you are not familiar with depreciation and you look at your tax return and it's not being done, you need to start doing it because it's not an option. Even if you don't take it, the government is going to assume that you should have done it.
Yeah. I hear people talking like that, and I'm like, that is the dumbest thing. Like, you're just shooting yourself in the foot here. Like, you're going to be forced into this recapture tax, like you said, as if you took all the depreciation. But if you didn't take the depreciation, then you're kind of a fool, right? Like, you're
right. And think
tax.
of the time value of money, just like you said, if someone got $90,000 in their pocket, what could they do with that now? You could reinvest, make money, put it in the stock market. I mean, even if you draw 8%, that's more than you would have if you just let the government use your money for 27 and a half years. And when you recapture, if you pass it upon death, then the person who inherits it gets to step up in basis. And then they don't have to pay until they then sell.
Why don't you break that down into layman's terms? So obviously the recapture tax when you sell is bad because you're paying a lot of that tax back. But how do you avoid, you just mentioned a strategy for avoiding that.
Right. So if you have an estate and you plan to just pass your property, and some of I'm sure your clients, that's how they have inherited their property that they have now. So upon death, what happens is if the person bought it for $300,000, maybe did repairs. So let's just say it's $400,000. Plus they have some depreciation. Let's just go with just say $500,000 to make it even. So $500,000 is now the basis, which is, it's kind of like the value of the house, the IRS value, the basis. If that person then dies and he passes it to their beneficiary and now it's worth $2 million, now that person has their basis is $2 million and they can do cost segregation on that $2 million. They don't have to just do it on the $500,000. So that's the good part of, waiting and letting it pass to your beneficiaries.
Yeah. I mean, that's a huge benefit for people who have a hard time understanding that. Like I'll give you a perfect example. I was looking at a deal that I was trying to invest in, and it was a small multifamily. Seller had owned it for 30 plus years. Their basis in it was really low, and their spouse had a terminal illness, and they were trying to liquidate the property, and we were negotiating and getting close on the deal, and they ended up talking to their tax advisor, and the tax advisor was like, "Do not sell this house. Don't sell it right now. There's going to be so much tax due." I mean, this is kind of morbid to talk about.
Yeah.
You need to wait till your family member passes on. This gets stepped up in basis. Sell it then, and you're not going to basically pay any tax.
Correct. So if they were to inherit it and sell it the next day and no increase in the fair market value, you pay no taxes.
Yeah. Which is the right move for them in their situation. Yeah. Like, it would have been a mistake to sell it when somebody is clearly going to pass away in the very near future, which is why it's so important for anybody who wants to invest in real estate or anything specialized that you get proper advice from people who understand how how this works. That CPA just saved that couple probably hundreds of thousands of dollars, for sure. Hundreds. I think they bought the property for like $200,000 and it's worth close to $2 million now. So a lot of money that they saved them by just telling them
just to wait. Yeah.
Don't do that.
Yeah, because they could have, even if they needed the cash, they could have gotten a loan on the money. They could have gotten a line of credit or some type of funding, but don't sell the property.
Yep.
So, yeah.
And it was kind of a bummer for me, but in the end, I want everybody to win. And that was not going to be a win for them. And that wasn't even on my radar at the time when I was just in like analyze and purchase mode. Obviously, they have different considerations. And thankfully, I'm glad that they figured that out, because that would have been a really hard lesson to learn after the fact.
Yes. And I cannot stress enough, talk to your attorneys, your advisors, your CPAs, for major decisions. A lot of times things are done and it's after the fact and it's tax time. And then I'm saying it's too late. You know, you made the wrong move. I wish you would have consulted with me.
Let's talk about that. So there's a difference between someone who prepares tax returns, whether they're CPA or not, and somebody who like advises on tax strategies and planning. Most people that are just earn a W-2 income, they're just going to see their tax person, you know, come after the 1st of January, they prepare their return and then they don't talk to them again until the next year. What's the difference between that type of a professional and somebody who does tax planning and, you know, forecasting tax liability and ways to avoid it? Like, speak to that for a second, because I think a lot of people don't understand how that actually works.
I'm so glad you brought that up, Peter. I am so glad, because there is misunderstanding. A tax strategist, which is what I am, we're looking at things before they happen. Tax prepare a lot of times is just looking at after the fact, like all the decisions have already been made. So with a tax strategist, we're looking as decisions are happening in your life, things are changing, and you're consulting with us to make those decisions. So a tax strategist is looking at how it affects your retirement. We're looking at entity structure. What's the best structure if you're starting a business or getting into real estate? Like the situation where someone is ill, terminally ill, what should you be doing now with your assets and your investments? We're looking at your return on your investments. Is it best for you to start a business or get into real estate or invest in paper or invest in commodities? So we're going to help you look at all different types of building your wealth and growing and paying less taxes. My goal is to help you pay less taxes. So I'm going to look at what is the strategy to help you do that. I want to figure out a way. And the tax code is huge. There's lots of loopholes, a lot of things people don't know. So I love working with individuals to help them strategize.
Yeah, good point. Sometimes I think the tax preparers, and no knock to them, they provide a service. They're incentivized to prepare as many returns as possible because that's how they make their money, is just crank those returns out as fast as possible. They don't, by design of their model, they don't have the time to do tax planning and go in depth, especially when everything's after the fact. They may, not that they wouldn't tell someone, hey, next year, don't do this, do this. Right. But it's just a different mindset. And I agree with you completely. Like, it's a very rare person that understands the legal side, the tax side, the investment side. Like, I don't know many people that are experts in all of that can just do it on their own. You need to surround yourself with professionals. Right. That's what they do day in, day out, and they know it better than you. And that's frankly why you retain their services, because they're the expert. And you shouldn't think that a CPA knows it all, because I work with an asset protection attorney. So he's specializing in protecting your assets so that if you are sued, how do you know that you're protected? Then you may have someone that deals with trust and estates. That's a different person. Then you have a business, attorney. And then on the CPA side, you may have someone that specifically works with restaurants. I don't work with restaurants. So it is important to understand this, really specialized areas that each of your professionals have. It's very important. Yeah, definitely good advice. Well, this has been a great conversation. Hopefully we illustrated some legal ways to pay less in taxes that, with two very closely related strategies, the long-term rentals versus short-term rentals. And in my mind, even if you don't like managing a short-term rental, do it for a year and then convert it to a long-term rental. Get the big chunk of the depreciation up front and then go turn it back to passive, which for me, it seems like a really good strategy if you don't like the short-term thing. Anyhow.
Right, yeah. Just put in a little bit of elbow grease just for a little bit of short term.
Yeah.
It'll be worth it.
Very good. Well, Catrina, if our listeners are interested in seeing what you're up to or reaching out to you, you obviously are a wealth of knowledge when it comes to real estate investing and taxes. What's the best way for them to stay in touch?
So I'm on all socials, Instagram, LinkedIn, Facebook, YouTube, as Catrina M. Craft. And I have a special where I'm going to be doing a special class on real estate and the tax deductions. And that can be found, you can sign up for that at Catrina. No, it's not. It's Craft More Cash. craftmorecash.com/real estate wealth. So craftmorecash.com/real estate wealth, and sign up there and I'll have a masterclass.
Perfect. I think our listeners should definitely do that, because you can never know too much about this. And the more you know, the more you save, the more money you make, the more money you have to invest elsewhere, and all of those things. Catrina, thank you very much. I really appreciate what you brought to the show today, and thanks for coming.
Thank you, Peter.